Sure. Not so long ago, the process of choosing a mortgage loan is relatively simple. You might go to a national bank, you might go to a local community bank, but in either event, you had to choose a term, 15, 20, or 30 years. And while there were some adjustable rate products, you usually chose between an adjustable rate product and a fixed rate product. That changed in the last decade because lenders no longer made their money from the interest on a loan over 20 or 30 years, but instead sold loans and packaged them to be resold to investors. The result that we witnessed was a drive for volume. And what happens after the drive for volume by these lenders was they invented ways of getting more and more people mortgage financing that previously might not have qualified. And that resulted in what we view as exceedingly risky products, sometimes called exotic loans, that became much more popular from 2002 forward. And as you mentioned, now that might not be the case anymore because things have somewhat returned to normalcy. And generally speaking, that's a good thing.
In other words, a lot of people were able to get loans pretty quickly without doing their homework, but some of that is what has created the problem we're in now. And frankly, for people now looking to get into the market, I think our advice is have to be a little more careful. Let's just talk briefly about those adjustable rate mortgages, or those ARMs. Can you just explain what they are and how they contributed to that problem in the past?
Sure. Our office experience indicated that they were a major driver of what we're now seeing in the foreclosure crisis. Generally speaking, in the old days, banks would look for borrowers to spend 30%, maybe 35% of their income on their housing expenses, their mortgage loan. And what changed was that number increased dramatically, up to 45, 50% of one's income dedicated to home expenses. But then the lenders also often found a way to keep the payment low for a time period, usually 2 or 3 years, through a fixed rate that then turned into an adjustable rate that caused the monthly payment to increase predictably, sometimes by 20, 30% or more. And that resulted in what we call payment shock, where the loan products led to a payment shock that homes that were affordable for a short term were no longer affordable. And it's those products that I think are now off the market, both because of new state and federal regulations, but also because that business model essentially failed because so many of those loans ended up failing.
Well, and if you had a loan that was going to go up after 2 or 3 years, but you thought you could refinance, that option was gone once the market changed and house prices leveled out or in fact dropped. And so as we look at what a homeowner needs to be careful about today, I think one of the warnings is you need to do your work so you know what kind of products you can afford and what are going to be good for you. Michelle, can you talk about, let's say you're about to get into the market, maybe a good time to do it. What are the things that a new first-time homeowner should think about before they even start visiting homes or start looking for products themselves?
I think it's really important to understand the full process, to really understand where to start and then where to end, and all the steps in between. And part of getting that information, there are resources for home buying classes where you can find out about how the process works, but also about what lenders are looking for and what kind of mortgage products are available to you.
Now, this may be a new concept for people, that you have to go to school in order to buy a home. But tell us why it's so important that people really take the time to understand their own situation, but also what they should be doing to make this big investment.
This can be one of the biggest purchases somebody makes in their lifetime, and coming to a class gives you an opportunity to find out the process and ask all the questions so you can fully understand not only what you're getting into, but what you really want to put up forward for your mortgage. How much do you really want to pay? How much will that lender lend you? What should your credit look like? What are your options? Without that class, you may have a harder time figuring out exactly what your options are.
And it's really about making good choices and
Yes.
having the basis to do it. And we've seen what's happened when the process has been sped up, when people went into it too quickly. It really is a huge investment. Where can people go to find a class? Where are some of the resources that are available to let them know where they might go?
There are classes all across the state. I would recommend that people look at the website for the Citizens Housing and Planning Association. That would be chapa.org. You can find them at your local towns. City of Boston holds classes. My organization, Allston, Brighton, CDC, teaches the classes, so there may be classes in your own neighborhood.
And folks can go to our website, mass.gov/AGO, and get links to some of those resources or call. But we really urge that people do this. What's the time commitment? How do these classes take place? Over what period of time?
The classes typically are 8 to 12 hours, depending on who's teaching the class, and they may happen over the course of 2 days or 4 evenings.
And how about fees for those? Are they available? Is there a tuition cost involved?
There may be a small fee depending on the organization, and that typical fee could be about $35 for the cost of the class, and this typically is what covers materials, producing materials for your benefit.
But considering the kind of investments people are looking to make, that's a pretty good investment
Yes,
for that, and you can
definitely.
avoid a lot of problems down the road. And what kinds of, can you give us an example of something that might be focused on in some of the early classes for consumers?
When you first join a class, two of the typical things that start the class out are learning exactly what the lender is looking for, how you need to get your finances in order, and then really focusing on savings, budgeting, credit. Where does your financial picture need to be in order to qualify for a good mortgage?
Okay, and now Chris, we've been to class. We're looking at this market where prices are lower and interest rates are good. What are some of the concerns that a homeowner should think about in terms of buying products? We mentioned ARMs. Can you just mention some of the options that people have and what they should think about in terms of buying mortgage products? We're talking about products, but we're really talking about mortgage or financial products.
Sure, we're talking about mortgage loans, and I think that the starting point is, as Michelle mentioned, there's no substitute for determining what your budget is, how much you can afford to spend on your home, and then, with that starting point, looking for the right product. Some of those things that I mentioned earlier, the artificially low payments followed by an adjustable rate or a higher payment, mostly are no longer available. So we're returning, because the companies aren't selling them anymore, the companies themselves are out of business. We're returning to what I described at the outset. You may have a choice between a fixed rate and an adjustable interest rate, and you'll have a choice as to the term, but those decisions should be made with respect to what you can afford now and what you anticipate being able to afford over the long term. So the budgeting is a necessary first step, and then your choices may not be as voluminous as they were a few years ago, but that's probably a good thing, because all of the products now should be designed for sustainability, not for refinancing in the short term.
Right, we're looking at the long-term success of these loans, something we didn't do. And so, very quickly, because as our time has gone by, as people are looking to get into this market, they need to do their homework, go to class, figure out what their income or joint incomes are going to be, and then what can a homeowner do, a prospective homeowner? What do they start to do?
They look at their income, they look at their debt, their credit, and they look at piecing together a really good real estate team and looking at high quality professionals. You want to think about who your lender is, what kind of mortgage are you looking for. You want to think about what type of real estate agents you're working with, and who's your attorney.
So that team is really important. Again, along the lines of making sure you make good choices, you need to get the best advice. And you need to think about what the price of the home is, but also what's its location. Do you have a small family, a growing family? All those concerns that will help you decide. And then in this market, you may, if you have the team, you may be able to negotiate a price that makes sense for you also. Is that correct?
I think that's right, and another thing is to focus on getting pre-approved from a mortgage lender before you start specifically shopping for properties, because you don't want to get into the process and then find that you don't qualify for a mortgage loan and can't afford the home.
And in fact, if you're not pre-approved and you find the home you want, you may not be able to move quickly enough to get it. Is that correct?
Correct.
So fair to say the bottom line is, just like always, you have to go to school, you have to do your homework, because this is such an important decision people are making. And we urge folks to check our website or the links from our website to make sure that they are able to make the right choice and the right decision. Again, a good time for first-time homeowners. But thank you. Unfortunately, our time is up. There's a lot more we could talk about, but I want to thank Chris and Michelle particularly for joining with me today. We could discuss this for a long time, but for those of you at home, there is more information on our website, mass.gov/AGO, on these issues as well as others around the predatory lending issues we discussed earlier. And we hope that we can be helpful to you in our office. You can email us at ago@state.gov suffolk.ma.us, or call us at 617-727-8400. I particularly want to thank Suffolk University for hosting us here in their downtown Boston studio. And of course, thank you for watching, and we'll see you again soon.